Thank you for joining Market News with Rodney Lake. This is a regular program for the GW Investment Institute, where we talk about timely market topics. I'm Rodney Lake, the director of the GW Investment Institute. Let's get started. Welcome back to Market News with Rodney Lake. I'm your host, Rodney Lake. On today's episode, coming to you from the George Washington University School of Business, Duquesne Hall, Duquesne Family Studio. This is a production from the GW Investment Institute, where our students manage just over $11 million of real endowment money here at the George Washington University School of Business. Today's episode is going to be on Microsoft. So we haven't done an episode like this in a little while, so we're going to bring it back. And so this is the type of work our students do in our classes. We're going to use our framework by the GW Investment Institute, business, management, price, valuation, and balance sheet to evaluate Microsoft. Microsoft is one of our holdings. Microsoft has absolutely been in the news. People have their concerns about it. So I thought maybe let's take this opportunity to pause, pull back. Let's check out Microsoft. Let's see how it's doing. Let's use the framework to evaluate it today. This is coming up on mid-February 2026. So let's really think about, where's their position? How's the business doing? What do we think about management? What do we think about the valuation right now? And, what's the balance sheet looking like at the moment? So let's kick it off. All right. So let's talk about the company Microsoft. So I think many people know Microsoft, but let's get a few stats on the company. So let's go here. So right now, again, sort of, I'll date it even further here. 2/10/2026 is when we're recording this. Share price $420.31 today. While we're recording this. And so what's the year-to-date number for the return? Minus 13%. That's why we're talking about it. Like, should we be concerned? As an example, it's up to date, but should we be concerned about this? The year-to-date numbers are looking tough. Where does that put the market cap for Microsoft? That puts the market cap at just over $3 trillion. So, they're doing okay. $3.12 trillion. And so obviously a very large company. It's one of the largest companies in the world. Now, this is obviously a company that is well known, and people use their products. If you're using, Windows, if you're using the Office products, if anybody uses Copilot, put it in the comments and let us know, because I don't know anybody that's using Copilot. But if you are, let us know. Love to hear about it. And so let's now think about, okay, well, what's the revenue look like? We got the market cap, $3 trillion, but what's the revenue look like? All right, so this is if you look at the last 12 months, this is $305 billion. So look, these are huge numbers. They have a June 30 fiscal year, by the way. And so if you do the trailing 12 months through the end of the calendar year, 12/31, which is not their fiscal year is June 30, but the trailing 12 months, $305 billion. So these are very good revenue numbers. And it grew 16%. So that's a very good growth number. So you're talking about an enormous business, and it still grew 16%, and it's on track basically to grow 16% for the full fiscal year, June 30, 2026. This year, 327 is the number, up from 281 for the full fiscal year for 2025. And so 16% growth number on 280 billion to 327 billion. These are enormous numbers. And so those are more than pretty good growth rates for that. So now, what's the profit margin? So that's a lot of revenue, but what's the profit margin? So you're talking gross margins right now that are at 68% for the trailing 12 months. And so projected about 68%, just to tick down from that for the fiscal year. But let's go back. How consistent has this been? This is one of the things that we talk about. Should we be, at all worried on something like that? And we'll go back to the revenue number for 1 second after we do this. So the gross margin, 2022, 68, 23, 68, 24, 69, 25, 68, almost 69, 68 again for the trailing 12 months through December 31, 2025, projected 67 and 27. So as investors, at least for that number, that's not a concern. Gross margins continue to do well, so they continue to performing there, not a big concern. Now, one of the things that people may be concerned about is that you have a slight tick down in the projected 2027 to go back to that sales number I talked about, the revenue number. So from 327 projected 630 this year, 2026, to next year, 378, 15%. So that's only modestly down. When you're talking about these enormous numbers and huge gross margins, that's still good. And so, but the market is absolutely concerned that maybe Microsoft is spending too much CapEx, or maybe they're not finding their way, or maybe this relationship with OpenAI is not working out the way that people want it to. And, it looked like early days with that relationship on the business side that Microsoft was positioned super well in the AI game, and really they were backing the leading and at the time really the only option for the large language models that open to consumers and people are using, and that growth rate took off. And then Google had Bard, and it really didn't work out, and now it's Gemini, and it's working out much better. And so Microsoft looked like they were in that early lead along with OpenAI. Now that has shifted, and I think people are more concerned there. So that's something that we have to think about. But let's drop down and look at the net income here. So net income for the trailing 12 months, $111 billion. And the projected is 125 for the full year, again, June 30. And that's up. The gross margin, or rather the net margin, is 38%. So let's go back. Let's think about, should we be concerned here? Is the net margin dramatically different? Is it declining? So if you go back and you look at the net margin numbers, 2022, 34, 23, 34, 24, 36, 36 and 25, and then 36 again, and now going up to 38 and 37. So actually the net margins have modestly, these are already great net margins for such a large company, they're good. And so no reason to be concerned. And so if you look at, earnings per share have grown. And so earnings are growing, earnings per share is growing. So not a huge concern. And that's actually gone up significantly. And so it's not something that we should be super concerned about. And so, but what are people concerned about? People are concerned that Microsoft is spending too much on the CapEx. So let's dive into the CapEx budget here while we're talking about the business. Now, if you listen to a prior episode, I am pro spend the money right now because I do think this is a winner's game and you have to play to win in this game. Now, it doesn't mean that you're going to allocate that money appropriately. So that is up to the management team. We'll talk about that Nadella here in a second. But, I think if you want to be in the game and you want to win at scale, that you're going to have to play at scale and you're going to have to allocate the capital to do that. And I think the best informed companies, Amazon, Microsoft, Google, Tesla, they're doing that. I think that they understand the game, and I think they understand that the allocation of capital, they have to get it right. But I think that step one is that I think they see the imperative that they have to be in that game. So if you look at this, but this is the concern. So look at the CapEx budget. So the projected here, 105, and I think it's going to be bumped up even slightly for the full fiscal year 2026, and then expecting even more for 2027, 124 per year. Now, let's dial it back and see what's the change here. So if you go back, for example, just to 2022, so that's not even that long ago. You're talking 4 years ago. 2022, June 30. Not even a full 4 years, right? Coming up on a full 4 years. The CapEx budget, any guesses out there, $23 billion. So that is now a fraction of what, this is going to be coming up this year. So less than 25%, really like 20%. So it's 5x'd in 4 years. More, and it's going to be more than 5x. That is a huge increase over a fairly short period of time, and that is for the AI game. And so if you look at the next year, $28 billion in 23, $44 billion in 24, $64 billion in 25. And so you can see it ramping, $83 billion for the trailing 12 months through December 31, and the projected full year over $100 billion, probably closing in on, let's say, $145 billion for the full fiscal year 2026, ends in June 30, and the projected over $100 billion again in 2027. So that's where the concern is coming from. So when we look back, we talked about the numbers for the business, so let's give some scores here now. That's part of the framework. 1 to 10, remember, not investment advice, entertainment purposes and educational purposes only. So out of 10, what are we giving the business? I think we can give right now the business a 9 or a 10. It's very good, high gross margins, high profit margins, good growth rates, growth in earnings per share. This is a good business. So right now, again, that can be disrupted. We're taking a snapshot when we're doing this evaluation. So but we obviously have to make some projections. And so, but you talk about Microsoft Azure, talk about productivity, Office 365, and certainly these products are pervasive throughout corporate America, and they're a big enterprise client. I don't think we'll spend a ton of time here on management, but let's talk a little bit about management. So they've actually been these, we talk about capital allocation on the CapEx budget, that's driven by management. So, even though I think that there are issues there, still going to give them a 9 on the management right now. Satya Nadella doing a great job. He's the one who repositioned the company away really from Windows, let's say, to overutilize that, to really cloud-based and now AI-based. And so I give him a lot of credit. So I do think the CapEx budget is justified. And again, I think these companies that are doing that are playing to win. And so if you give a 9 there, you could drop it down to an 8 if you want, but has done a very good job. And so business, again, we went more over that. The management, obviously interconnected with the CapEx budget. That is the capital allocation. And I think as an investor, business person, analyst, you should be watching that super closely. Those things are obviously tied together. The management obviously needs to run the business and allocate that capital. And when that free cash flow comes out, you have to decide where it goes. So I'm giving a 10 to the business, a 9 to the management right now. And so now we're going to talk. Let's go back to price versus valuation. We might mention management again here, but let's go on to the price versus valuation. So how is Microsoft doing? And so this is a solid company. This is a stable company and stable earnings. So I think we can just use the PE to talk about that. So if you look at where's the PE now, so the forward PE here is not crazy because it's sold off. Again, it's minus 13% year to date down. And so if you look at the forward PE, you're at 25 times. That is not crazy. That is not a crazy PE. You're approaching market multiple really for a fantastic business with high gross margins and high net margins and growing and is at least has a seat at the AI game. It may or may not win and be one of those winners, but it's definitely in the game and it's playing to win that game. And so if you look at that multiple, it's like, well, that's not a crazy multiple to pay for such a fabulous company that has a great track record, that has great assets, that has a great network effect. But people, again, are concerned, and that has sold off considerably. Again, trading at 420.23 right now as we talk about it. So, all right, so let's go back to the scoring here. So if we give that score, you can probably give that a solid 7, right? If it were even lower, maybe you could give it a higher score. But, I think that's a solid 7 on the price versus valuation. Maybe you could give it a slightly better, slightly worse, but I think that's a solid 7 on the PE there. Again, the forward PE is nothing crazy. 25 times, I think, is very reasonable valuation at the moment for this. Now, let's get into the balance sheet. All right, this is pretty easy. So for the balance sheet here for Microsoft, what can you say about this fortress balance sheet? It is maybe a 10 here, but let's talk about it. So what do we have on the balance sheet here? 123 billion of debt and 89 billion in cash right now through 2025. But if you look at, okay, well, what's the free cash flow? $77 billion. And so you're definitely not, overly concerned about the balance sheet for Microsoft, and you're not worried about it. So one of the other things, so you do have some net debt as of now, but not, with the free cash flow, not worried about it. And so let's then look to the interest coverage ratio. So for everybody, remember, that's EBIT, earnings before interest and tax, over total interest expense. What's that number right now? 53 times. And so over 10 gets you more comfortable. 50 times, no problem. This is a fortress balance sheet. So we're definitely not super concerned about Microsoft's balance sheet. I would call this a fortress balance sheet and not really a thing to worry about. Now, when you're spending this much money, that's something that we have to watch. When you're spending, so if you're generating free cash flow of 77 and you're spending 125 or more, now the balance sheet will have to have closer scrutiny moving forward, and that may change. So that's something as an analyst, business person, investor that we're going to need to watch and pay attention to. But as of right now, this is a fortress balance sheet. I expect it to stay a fortress balance sheet. Now, the projected free cash flow is actually still expected to be quite high. So if you look at even after these enormous CapEx numbers, and so the 77 billion of free cash flow is through 12/31/2025. That's after spending 83 billion on CapEx. And so the projections, so let's use the current consensus projections. I think it's going to be higher than this. The 2026 fiscal year for them is June 30. And so that is a 105 projected CapEx. That still generates 71 billion in free cash flow. And then the next year, consensus projections for 2027, June 30, that is 125 as a round number and 84 billion and free cash flow. So that's CapEx and free cash flow. So again, here we're not super worried about the balance sheet. Certainly not now, and not really in the near and medium terms for Microsoft. Now, if they accelerate their CapEx budget even more than they're expecting right now for the AI play, I think that we're going to have to think about that. We talked about on a prior episode that Google is issuing a $100 bond to help finance the CapEx spend on the AI. So we'll see what Microsoft does in this category if they do something similar. So let's go back to the framework. Let's really tie all this together. So I think at least now, again, this is a 10. I don't see how you could say it's really anything other than a 10, given the cash on hand, given the free cash flow, and even with really high spending expectations and current spending expectations, they're still generating a ton of free cash flow. Interest coverage ratio, remember EBIT over interest expense, that is over 50 times right now, so we're definitely not worried about that. So let's kind of do a recap for all these categories, and then we'll give a total score. All right, so back to the business. Now, everybody knows the business, and let's just review the gross and net margins as of now. So when we talk about the revenue side, and remember $3.1 trillion market cap, revenue of $300 billion through 12/31/2025. Remember, that's not their fiscal year, but that's the trailing 12 months. Gross profits of 200, that's a 68.6, if you like to get to the decimal point there, but let's just say 68% gross margin, fantastic. Then you talk about, okay, what's the net income? 111 billion. That's a 36% net margin. That is fantastic. And so again, then generating 77 billion in free cash flow. So when we go back and we talk about, okay, well, what's the business score? I think that's a 10. You could say maybe it's a 9, maybe it's an 8. But we can put it somewhere in that category. Right now, they are dominant. They are in the AI game, and they are playing to win. And again, I think that's the right move. Now, management, Satya Nadella, we're talking about such a fabulous management. They repositioned the company for the cloud and Microsoft Azure. Great job there. Very focused now on AI as well. Now, it looks like they had an earlier lead in that because they were at the table with OpenAI. Now, that partnership doesn't look quite as strong as it did in the past, certainly not out of the gate. Copilot has not really progressed, I think, as well as many people thought. And again, if you're using Copilot, I'd love to hear from you because I don't think it's quite useful at the moment, but maybe you have a different take. I think most of the other frontier models are doing much better. I know they rely on some of the back-end stuff from OpenAI. But in any case, I think management has done a fabulous job. Credit where credit's due for being early and certainly at least recognizing where the game was going and having that partnership. I don't think it worked out probably the way that they want right now, and maybe they won't say it that way. That's my take, not their take. But maybe they would be better off with their own frontier model. So next up here, is price versus valuation. And again, back to management maybe for a second. I'm giving them a 9. Price versus valuation. Let's just check the stats again before we go back to the score. So if you talk about the forward PE, 25 times, that's certainly nothing ridiculous. And again, I think that as a market multiple, in that neighborhood, not bad. But we can, ding it a little bit. Just call it sort of average here. That's a 7. But you can maybe say it's a little higher, a little lower. Balance sheet, again, not super worried. Very clean balance sheet. Interest coverage ratio, 50 times. It does have some net debt, but nothing to be worried about, and generating a ton of free cash flow. So not really worried about that. So fortress balance sheet. So when we put all that together, what does that get us? So the composite score, if you use, again, business at a 10, management at a 9, price valuation versus at a 7, and balance sheet at a 10. And again, you could modify some of these scores up or down, not above 10 in our framework here. That's a 9. So look, right now, Microsoft looks okay. Now, I think the market is concerned. If you go back, the year-to-date number here is down 13%. So if we're saying, the composite score using the GW Investment Institute framework right now is a 9, Microsoft still looks like a favorable company. Remember, non-investment advice, entertainment, educational purposes only. It looks solid. But I do think, obviously, you have to think about where do we go from here? What's going to happen from here? Are they going to be right on these massive CapEx budgets for the AI game? Now, I don't know, and I don't think anybody really knows what's going to happen. If you do, let us know, if you're from the future, as an example. But what we can say is, at least my view on this is, the hot take is that the companies that are playing to win obviously have a chance to win, where success is in the set of outcomes. And so it may not be assured, but certainly I do think that the AI game is for real, if you like to say it that way. And I do think the companies that are playing to win are going to have a real shot at winning, obviously. And I think when you're doing this at scale, it's going to make a significant difference, not just this year, next year, and the year after, but certainly in the next 3 to 5 years. And I think companies like Microsoft, Google, Amazon, Tesla, NVIDIA, they are absolutely playing to win. And again, the specific capital allocation has to be evaluated. You have to see if it's efficient. You have to see if it works. But the start for all these companies, which I'm a fan of, you got to put the money to work. You got to go out there and try to win this game, because the productivity gains is a multiplied effect. And I think it's going to be a non-linear return for the companies that deploy this capital. I think the ROI is going to be very high. And I do think it's going to be winners and losers. And I think you got to set yourself up for success. And I think that means you need to deploy some capital to try to make that work. Now, none of us know how this is all going to turn out, but I do think you have to play to win. And Microsoft, I do think, is playing to win. Now, that's it for this episode. If you like our episodes, keep watching. Tell your friends. We'd love to have you back on the next episode of Market News with Rodney Lake. But for today, that's it. Thank you. Disclaimer, the content shared in the GW Investment Institute podcast is for informational and educational purposes only and should not be considered investment advice. The opinions expressed in this podcast are those of the host and guest and do not necessarily reflect the views of the GW Investment Institute or the George Washington University. Listeners should not act upon the information provided without seeking professional advice from a qualified financial advisor. Investing involves risks, including the loss of principal. The GW Investment Institute, the George Washington University, and the podcast hosts do not assume any responsibility for any investment decisions made based on the content of this podcast. Always conduct your own research and consult with a financial advisor before making any investment decisions.